Hey everyone, welcome back to the Atlanta Startup Podcast. My name is William Leonard, your host for today. Really excited to be sitting down with someone who I've known for some time now, and Kevin Moore. Welcome to the podcast.
Thank you for having me. Good morning.
Kevin, it's great to have you on. You are now the managing partner and founder at Serac Ventures, and we are going to dive into all things Serac in this podcast. But I really want to jump right in. Your background is very interesting. You've been in the world of financial services, Northwestern Mutual, Morgan Stanley, the Federal Reserve. Then you were an LP, a limited partner, for some time, and then now you switched over to the GP, the general partner side of things with running Serac. I would just love to hear you take us down the path from LP to GP.
Absolutely. Thanks for allowing me to come on the show and share a little bit of my story. I think that one of the things I love about people in the venture capital industry in general is just the versatility and non-linearity of their backgrounds. And I feel like in venture capital, having multiple experiences allows you to relate and understand the path of so many different entrepreneurs. Yeah, I guess one missing piece before becoming an LP, I worked at a firm called I2E where I was investing in startups. And it was there where I was raising capital for one of our funds and called on a fund of funds and didn't realize that this organization was within our state, Oklahoma. And I went to work there as a partner. And that transition of going from the GP side to the LP side was an interesting one in that it was a different framework by way of looking at investments. But I always considered myself an investor. And that was one of the things where I said, well, if you're an investor, you should be able to think about investing as a framework and apply that to whatever medium. So working on the LP side was enlightening. I will tell you that it is something that I think a lot of GPs have not had the experience or chance to do. And it's certainly been one that has been additive to the role that I'm in now, sort of on the GP side, and especially in the managing partner seat. So
Mhm.
happy to go in any direction there, but we could dig really deep into this, but I want to make sure that that's just sort of the overall benefit I've got from seeing both sides of the table.
You're right. There is a lot of overall benefit there, and we will certainly dive into that. I would love to get more context on the thesis of Serac, right? You have started a fund at such a unique moment when we think about where venture is today. So when you were thinking about starting Serac, how did you go about crafting this thesis to fit within the ecosystem? What did you see missing in the capital stack? And how did you think about Serac's differentiation? All the things you go through mentally when starting a fund.
I will say, to be honest, in hindsight, 2023 was the worst time to start a venture capital fund. Obviously, I didn't know that at the time. The idea of starting a firm started around 3 or 4 years ago. It had always been something I'd always wanted to do since graduating college, but filling in the knowledge gaps was something that definitely needed to happen. And it was probably about halfway during my time as an LP, having been able to peer inside the portfolio of so many different fund managers, where I started to see there was an opportunity to say, one, there's not enough representation in the venture capital industry for people who look like me as a person of color. And then two, there were some amazing emerging large categories in the market where amazing founders were building great technologies, such as in the future of work category, the creator economy category, and obviously with companies that are sort of expanding access to financial services. So when I started to think about that in regard to a fund, uh, 2023 was really a year of refining that, and then I brought on another individual to the team, Daryl Frater, and we were sort of talking about the categories where we were investing and what it is fueling in the economy. and this whole thesis of entrepreneurship as the future as the future of work. And effectively, what that means is we're trying to back companies that are expanding access to capital, products, and services that increase and make the lives of individuals and businesses easier, more efficient, and just overall better. And the companies that we've backed so far enable that, but that's the thesis of the firm going forward. And obviously, that might change over time, but really, the whole thesis is expansion of the access to services for the masses and not looking at venture, this narrow gap of it only helps a certain type of person and can only go into certain types of markets. So we have that versatility at Serac Ventures.
Future of work, expansion and or democratization of services for the masses is a really interesting place to be at right now as we think about, one place I think about that being hyper relevant is sort of the alternative investment space. You've got so many platforms now that are popping up allowing consumers to invest in alternative asset classes like wine or real estate or whatever it may be. When you think about the traditional kind of stock market and how people were in that during the pandemic, and now they're transitioning into unique things, gold, stocks, or whatever it may be. So, as you kind of think about that, what part of the capital stack relative to venture are you focused on? Is it seed? Is it pre-seed, Series A? Any geography bounds? Tell us more about that.
Peter Wagner at Wing Ventures years ago did a study called I forgot what, I think called it the cannonball effect or something like that. Effectively, what it was a research study on how companies have been able to do more with less at earlier stages in their life cycle. And when he compared Series A stage companies 10 years ago, they were at the same valuation and had made the same type of progress as a seed stage company today. And that really reinforced Serac's thesis to say, hey, you know what? We can come in at the seed stage, add a lot of value, get respectable valuations, and not have like these crazy enormous round sizes and still be able to make an impact because these companies have progressed so much further along by way of what they can do with technology, their ability to work virtually and have super talented people on their team all around the world, the proliferation and ease of advertising and getting their products out to market. There's just been like a huge paradigm shift in how companies can come to market and can do so much faster. So that sort of galvanized, okay, seed, and then even now looking at pre-seed companies that have made significant progress to where now you can look at it like a late pre-seed stage company is one where they're at the brink of being a seed stage company, but they might be classified as pre-seed just because of their round size or because of their valuation, but it says nothing to the fundamentals of the company. One of the things that I like to look at in a company is their pipeline and where they're going. And getting into a company early, you can get a sense for how they're doing that, how they're going to market, who their potential customers are, which is something that we try to do is talk to their potential customers to get a sense of, is this a company that's poised for hyper growth? So the semantics around, is it pre-seed, is it seed? There's a framework of valuation, round size, pipeline that we look at to determine, okay, is this a company that we want to back? If it's beyond that and it's a Series A or Series B or later, generally the round sizes are too big for us, but the seed, late pre-seed stages are where I think we can be the most effective and add the most value.
I agree with that. And you mentioned, right, I think pre-seed, seed pretty much have a different definition depending on what region of the country and world that you're in as well. Certainly a pre-seed in the Bay may be different from a pre-seed in Oklahoma or Atlanta or Miami. And You're right. It's about developing a framework as a fund and as a team. And you also mentioned how there's a different sort of speed and efficiency to market today that are enabling companies to be a little bit more mature than they would be, let's say 10, 15, 20 years ago. And I think that's definitely attributed to this paradigm shift that you mentioned, also this platform shift of now having AI at the table to build applications and do the role of, several team members with a team of three. And so I'm curious to hear, at Serac, you and Daryl and the broader team, how are you all thinking about AI in terms of specific verticals that you're interested in, whether it be along the future of work or unique ways that you want to or are thinking about deploying AI internally at Serac?
I love AI. I love technology. And what I mean by that is I love how certain technologies can make existing processes and workflows and even data collection and automation easier, better, and faster. Now, AI to me, having been around investing for the last 18 years, not, and again, that's not all in the private markets. 8 years of that was in the public markets. But what I think about is not so much the technology, but I think about the utility. And to me, utility is so much more important than anything regarding technology. And I've seen of several companies over the years and even other sectors over the years that have fallen because people were so enamored with the technology that they weren't thinking about, okay, what's the practical application and is this actually going to help us make money? I think the last big technology, I wouldn't call it fail, but hype cycle was Web3. And Web3, phenomenal concept around everything being super decentralized, and there would be no need for any corporations or even a central government into to some extremes. I think that the ideology of that is great, but the practical application never materialized. I think AI is a little bit different in that it's a phenomenal technology that applied to so many different sectors can make things more efficient. There's obviously a fear of AI coming in and destroying the current sort of employment infrastructure that we have today. But other technology cycles have occurred like this over time. AI is just another one. So I don't dislike AI. I love it. We think about it. It helps a lot of things that we do at Serac Ventures by way of collecting information, writing, and putting out content. Great utility. I've seen a number of companies in this space that I think that we'll even back. But again, at the end of the day, is it helping companies to get access to capital, better products, and better services? That's the question that it has to answer, regardless of what the underlying technology is.
Yeah. I know I hear dozens of pitches. I know you hear a lot of pitches as well. Companies will say there's AI in their product.
Right.
And you kind of get under the hood, you do a demo, you use the product, and you see there's really not. How are you from a high level diligencing AI opportunities that come across your table? Oftentimes these deals are pretty hot, they're moving quickly. Um, at least there's a lot of FOMO created around the opportunity from the founder perspective. But how do you all think about diligencing an AI opportunity that comes across your desk that you're interested in, but you're not sure, is this actually proprietary or not?
One of I'm not a technologist, and in order to fill that gap, there's a couple of people on the team that I trust who really know that space. Brylan Donaldson and one of Serac's guild members or advisors, Garland Moore. Whenever I'm looking at a technology and at the application layer, if I can't understand it and it's going sort of toward the deep tech sector, I always bring in these experts to help me understand, hey, is this actually doing what it says on the back end? And to the point where I have to do that, that's when I start to feel like, oh, this is a company that's actually building the tools, like the internal wiring behind what is making this technology work. The surface level things where it might be a B2C application and they're utilizing AI for some superficial purpose, that's not necessarily the underlying tech. And to me, the difficulty in scaling that is you're now marketing a product which takes a lot of spend, and you're not essentially building a tool that can be used for multiple types of other companies doing the same thing that they're trying to do with marketing dollars. So that's the thing we're looking for. If we're looking at AI, the most attractive opportunities are ones that are building the picks and shovels, the tools that are fueling the companies that are actually utilizing AI. And those are, I think, harder to understand, hence the reason why bringing outside experts to help validate those opportunities.
Mhm, mhm. No, that's interesting. And Kevin, I want to shift back to, your time as an LP a little bit, right? You spent time there, I think, for 5 or 6 years or so. And curious to hear how you developed frameworks around decision making, from investing in funds to saying, hey, this is a red flag. I should double check with the general partner or the specific venture capital firm or whatever asset it was at this time about this, or I should ask them these questions. What decision frameworks carried over from the LP side to now how you think about decision making as a GP?
Yeah, I really like this question because I think about, again, as I mentioned, investing in general through the lens of frameworks. And if you're an LP and looking at a GP, or even if you're a GP looking at a company, you still have to ask these following universal questions. One, at the high level, what type of investments are you looking for as an investor? If it's a fund, then you're looking for Series A funds that do X, Y, or Z into X categories. If it's a company, you're looking for these types of companies in these sectors. So it's really just that high level question. The second one is, how does it add to the portfolio? It needs to be additive. It can't be something that's going to be less impressive or add less potential upside as companies or funds in your existing portfolio. The second one is, what is our process? Or the third one is, what is our process of due diligence? And are we sticking to that? Uh, when I was an LP, we had a system of things, that boxes that we checked, and we went through that like religiously. We do the same exact thing as VCs. We have internal frameworks and we have check boxes of things that we must gather, things that we must know in order to move forward. And the last two questions are, how do we approve the investment? Who's involved in that process? And what do we need to see? Are we writing a memo? How many references are we collecting, et cetera? And then the last one is probably the most important, is how do we monitor the investment going forward? Are we having regular quarterly check-ins? Are we meeting with individuals at their annual meeting? Or how are we collecting information to keep keep up to date with what's happening with those companies? So that's essentially the process. So I look at it like the process is no different as a GP, as an LP, or even if you're investing in the public markets. It's like, if you can answer those five questions and develop a process for how you're doing things, to me, your process is what leads to long-term performance versus just getting lucky on something because you got lucky, but you were making a bunch of mistakes along the way. And I forgot what book I read where they talked about this. It's like, if you follow a process and that process is well thought out and it makes sense, and something goes wrong, you can't be upset that it went wrong. You should be upset if you look back and you didn't follow your process. And that to me has made a huge difference in how I think about investing, is that structure of process.
Kevin, I really appreciate this perspective because there's a couple of podcasts that are out there doing a really good job of kind of demystifying how LPs think about investments. I know Swimming with Allocators by Ernest
Mhm.
Sweat is a really good one. Samir Kaji has a really good one called Venture Unlocked. But Another question on this tangent for you is how do LPs sort of think about alignment with the prospective funds that they want to invest in from, a thesis perspective and also how do they build conviction around emerging managers at fund one and in fund two? Any frameworks that you can provide for us around that insight?
I think people who have developed strong conviction around emerging managers are those who've had success investing in them. And I'll say this with a grain of salt. Many of the most successful funds that are in the market that have been around and are sort of brand names, many of them sold or they might continue to sell on the success of their funds one, two, and three. And there are characteristics to those funds that make them more successful. And again, this is my opinion, but to a certain degree, it's an educated one because I've seen it. Those funds, earlier funds, are usually smaller. They generally have a very concentrated focus on maybe one or two or three different categories. The decision-making process was really clean, and it was a one fund strategy. It was like, we're going to focus on early stage. Now, as those funds get more successful, they have a pre-seed, early stage, a growth, and in some cases, they might even have a fund where they're purchasing public. So then they're doing all these different things and they become these massive institutions. So when I think about just the evolution of how funds evolve and why people like these earlier smaller funds, it's usually they like that sort of narrow focus and concentrated strategy. And LPs today, especially with the pool of emerging managers that are coming out, are looking for sort of that next founders fund or that next Sequoia Capital or that next Coastal Ventures or whoever it might be. Because I think that there is something about being able to get in on the ground floor with a firm and a manager that shows the potential to really grow into an institutional level organization. And that's the hope that you're looking for. I actually been thinking about this question a lot, especially in the last 2 or 3 years, where there's been so many emerging managers come to market and the difficulty that LPs face with making the decision of, is this the right one that I'm going to back? I think that it's a great opportunity because there's just such a wide set of opportunities to choose from. But unless you can have that framework of what you're looking for, and I think that LPs who have done it before are going to be the ones that benefit because they've seen kind of how that system works and how they can actually be profitable there.
Yeah. No, that's really interesting, and hopefully that will resonate with a lot of the founders that listen, or founders of funds that listen to this podcast. We have a pretty diverse audience of early stage, pre-seed, seed, Series A, startup founders. A couple of fund managers that we have gotten specific and direct feedback from on how they enjoy the podcast. So appreciate that insight, Kevin. And as we wrap up this conversation, right? Serac is a young firm that has made some really exciting investments early on. Maybe you can walk us through, a couple of those deals that you all have done already and why you had conviction in the team or opportunity in TAM as well.
Yeah, absolutely. Again, just going back to frame that question, the general thesis at Serac is that intrapreneurship is the future of work. And for the last several decades, there's been a paradigm shift in the relationship of employer to employee. Employers are no longer rewarding employees for just longevity, but their creativity and their ability to innovate. And I think there's obviously some examples like Google where they reward people for spending their free time or they give them time to just create and come up with new ideas. And I think also one of the other things, what that reinforces is that our society is moving toward this entrepreneurial mindset where companies expect their employees to create and they're rewarded for that. So one of the things that has yielded is this whole thing about the creator economy and people creating content that is consumed in a completely different way than it used to 10 years ago. Most people are consuming on their mobile and at home. And one of the companies that we backed called Bump, they created a tool to help creators better monetize and not monetize, but better monitor all of the income that they're receiving from the content they're creating online. And they've teamed up with MasterCard to help those creators obtain capital that they need to grow their business. And this company has had explosive growth. In fact, they just sent me their last numbers. They more than quadrupled their year over year revenue from 23 to from 22 because of this surge of creators that are out there. And that entire market by 2026 is suspected to be $500 billion in market size, and it continues to grow. But it's just another example of a great company that's not only expanding access to capital, but is providing this platform to help creators in this new economy to be more entrepreneurial. And then another company, Solo Funds, super excited about what they're doing. It's a peer-to-peer lending platform that is allowing people to borrow and lend one to another in small dollar increments. Most of the time, if people need small dollar loans, it's very difficult to get that from a traditional bank. So they've set up and designed a payback mechanism and catering to these types of borrowers such that they can get the money they need for small things so they don't end up into credit traps and ruining their financial history in the long term. So it's companies like these that we're really excited about that fit those themes thematically, and we'll continue to look for those going forward.
Yep. I love it. I love it. Yeah, those are two interesting companies. I know you have a few more that we've talked about as well, but we'll keep it at that for the podcast. And last question or point, Kevin. I know you're based in Oklahoma City, which is a burgeoning startup ecosystem that has a lot of momentum behind it. Why is Serac in Oklahoma? And what advantage do you have of being kind of centrally located in the country when it comes to deal flow?
Well, I started the firm here, and I'm originally from Oklahoma, from Tulsa originally, and moved out of state, lived in Chicago. Then we moved back to Oklahoma City, which is where my wife is from. And all the things I did in the venture as a GP, as an LP, were all here. I think that one of the benefit of working in a small but fast-growing economy like OKC is really the support you have from your peers and business leaders to succeed, especially when you're building a company like a VC firm that has the potential to back transformative technologies that are going to grow the ecosystem. In the last year, when I was thinking about where I've been, I've spent a lot of time in LA, Chicago, where I used to live, and in New York City. And living in Oklahoma City in the middle of the country makes it so much easier to get to all of those places, which expands our access to entrepreneurs all over the country. We don't have an Oklahoma centric focus, but the ease of transportation to all these amazing markets, including the one that we're in, just enhances the overall portfolio overall. But I will say that founders in, I wouldn't call them overlooked parts of the country, but growing parts of the country, they're very scrappy and they have thrived for a very long time doing more with less. I can name a bunch of examples of companies that have had great outcomes because of that, but we're right here in the center of it, and it's a great time to be building a VC firm in an area where it's the next big wave coming to the shore. I think the waves that are near the shore are great, but the ones that you want to ride, kind of surfer analogy, are the big ones coming that you can't see, but are developing. And that's how I think about smaller markets around the country.
That's great insight, Kevin. This has been a really fascinating deep dive on how you think about life as an LP, how LPs make decisions and funds and fund managers, and then also how you think about Serac and your thesis unfolding and developing through the real dollars being put to work. So, how can a founder who's listening to this conversation get in touch with you? Is there a form on your website or anything like that?
There is a form on the website on the founders page that people can fill out. But if anyone wants to get in touch with me directly, the best way is just contacting me on LinkedIn. It is the preeminent platform, in my opinion, for reaching anyone. So reach me on LinkedIn, Kevin Joseph Moore. I'm out there.
Awesome. Kevin, really appreciate your time today. Thank you for joining.
No, thank you.